PayPal is trading at a 12 PE ratio, just announced its first dividend, and could potentially deliver 18% to 35% annual returns through 2028. But there's a hidden problem in the cash flow statement that most investors are completely missing. In this video, I'm breaking down the entire PayPal story, the good, the bad, and exactly how to approach this opportunity. If you're holding PayPal or thinking about buying, you need to watch this until the end because the numbers tell a very different story than the headlines. Let's start with what everyone's celebrating. Q3 earnings looked fantastic on the surface. Revenue up 7% year over year. Net income jumped 24%. EPS beat expectations. Management controlled expenses beautifully. This is exactly what the market wants to see: top line growth combined with disciplined spending. If you just read the headlines, you'd think PayPal has completely turned the corner and it's smooth sailing from here. But here's where it gets interesting. I don't trade headlines, I dig into the actual numbers. And when you look underneath the surface, there's a massive red flag that nobody's talking about. Let's go to the balance sheet first. Cash is up roughly 35% year over year. More cash is always good, right? Well, not so fast. Look at the debt to equity ratio. It's sitting at almost three times more liabilities than shareholder equity. For a fintech company that's supposed to be growing aggressively, that's extremely high. Most investors prefer to see something closer to one. When liabilities outweigh equity by this much, your entire risk profile changes. The question you have to ask is this leverage being used to fund real growth, or is this just a temporary patch while management tries to fix the business model? Now, here's the part that really concerns me, and this is where most retail investors stop paying attention. The cash flow statement, this is where the truth lives. Operating income was up 25%. That sounds amazing, but operating cash provided down 20% compared to last year. Let me say that again. Accounting profit is up 25%, but actual cash coming into the business is down 20%. That gap is the entire story. Why is this happening? PayPal has been aggressively loading up on loan receivables. They're essentially buying or originating loans with the intention of selling them later. This strategy inflates revenue numbers and makes some operating lines look healthier than they actually are, but it completely blurs the quality of cash generation. On top of that, they've been using collateralized borrowing to boost their cash balances. Now, these aren't necessarily wrong moves. Sometimes tactical decisions like this make sense in the short term, but this is not the same as clean recurring free cash flow. And for serious investors, quality matters just as much as growth. So here's the $1 million question: is PayPal actually undervalued, or is the market correctly pricing in serious execution risk? Let's talk valuation. Trailing PE is sitting at around 12. Forward PE is about 11. By historical standards, that's cheap. PayPal used to trade closer to a 17 PE multiple. The market is clearly pricing in either slower growth or higher risk, but here's where it gets really interesting. If you run conservative projections, let's say 7% revenue CAGR and 11% EPS CAGR through 2028, PayPal is already undervalued at current prices. A bear case scenario shows roughly 18% annualized returns through 2028. A bull case, if management actually executes, margins expand, and the market re-rates the stock, we're looking at mid 30s CAGR to 2028. That's a massive upside if they simply deliver on their plan. Now, there's one more piece that just changed the entire investment thesis. PayPal announced a dividend for the first time. It's an annualized 56 cents per share, which gives you about a 0.9% yield at today's price. The payout ratio is around 11%, which means it's very sustainable. This might not sound like a big deal, but it completely changes who buys this stock. Dividend paying stocks attract income focused investors, pension funds, and long term holders. The combination of dividend plus valuation makes the risk reward setup much more interesting. But let's be brutally honest about the risks. You cannot ignore these. Risk number one: leverage. A debt to equity ratio near 3 is material. If interest costs rise or if those loan assets start to go bad, this hurts fast. Risk number two: the loan receivable strategy. If those loans don't sell or if they underperform, cash flow could get weaker than expected. This is the biggest wild card. Risk number three: competition and margin compression. Fintech competition is brutal, pricing pressure is real, regulatory changes can compress margins overnight. Risk number four: analyst coverage is thin. When sentiment shifts on a stock with thin coverage, price moves can be extreme in both directions. So, what does all of this mean for you as an investor? Here's the reality: PayPal is sitting at a crossroads. On one hand, you have a deeply discounted valuation. a newly introduced dividend that signals management confidence, and a business that's still generating solid top line growth. On the other hand, you have legitimate concerns about leverage, cash flow quality, and whether this loan receivable strategy is sustainable long term. The market is clearly skeptical, which is why the stock trades at such a low multiple. But skepticism creates opportunity. The question isn't whether PayPal is perfect, it's not. The question is whether the current price already reflects all the bad news, and whether management can execute over the next few years to close that gap between accounting profits and real cash generation. If they can stabilize the balance sheet, improve cash conversion, and continue growing earnings at double digits, this stock could easily re rate back to historical multiples. That alone would deliver significant returns. But if they stumble, if loan losses pile up, or if competition erodes margins faster than expected, you could see further downside. This is why entry point and position sizing matter so much. You're not betting on perfection, you're betting on probability and managing risk accordingly. So here's a practical approach for investors looking at PayPal. Think in terms of three entry buckets based on your risk tolerance. Bucket A, run starter position. Consider a small starter position at the current price in the low 60s. This gets you exposure without overcommitting. Bucket B, in tactical add. Look to add more if the price drops into the mid 50s, somewhere between $54 and $56. This is a strategic accumulation zone. Bucket C is heavy add. If the price completely washes out and drops near $40 to $45, that's the deep value entry for long term holders willing to be aggressive. Now, if you want dividend income, you need to buy the stock directly. Leaps and call options don't collect dividends. Options can be effective for leverage, but they come with theta decay and volatility risk that can be painful during choppy periods like this. Let me give you some quick price scenarios so you have actual numbers to work with. Bear case, conservative assumptions: 7% revenue CAGR, 11% EPS CAGR, PE re-rates to around 13 by 2028. That gets you to roughly $100 per share by the end of 2028. Bull case, margin expansion plus a re-rating to a 19 PE multiple. That gets you to around $150 by 2028. Worst case, persistent cash flow weakness or loan losses. Be prepared for drawdowns. This is why position sizing matters. Here are a few tactical rules before you act. Rule 1: use staggered limit orders. Don't try to catch a single bottom. Place limit orders across that $54 to $40 band. Rule 2: if you trade options, stick to long dated calls or cash secured puts at strike prices you're comfortable owning. Remember, selling puts generates income but obligates you to take assignment. Rule 3: keep position sizing to a single digit percentage of your total portfolio for new higher risk exposures like this. Rule 4: watch the key signals. Track the debt to equity trend, operating cash conversion, loan receivable performance, and dividend growth guidance. Final thought: PayPal is not a hype play. It's not a rocket ship right now, but it's also not broken. Q3 looked solid on the surface. The company is reorganizing under new leadership. The dividend plus valuation creates an attractive base for long term investors who can stomach near term volatility. For traders, this is a timing and risk management game. You have to respect the leverage and the cash flow questions. For long term holders, scale in and treat weakness as opportunity. Tell me in the comments, what other stocks should I analyze next? This is Vikram Singh. Trade clean, size small, and always have a plan. I'll see you in the next analysis.